All right, let's talk Synopsys. Their Q3 earnings report on September 9th? Well, it was a bit of a bombshell, triggering a huge meltdown in after-hours trading. So today, we're going to dig into what exactly went wrong, how management is trying to spin the story, and most importantly, what this all means for the stock going forward. Let's dive in. I mean, just look at this. The market's reaction was swift and just brutal. The stock absolutely cratered, down a staggering 18% in after hours. This wasn't some minor hiccup, you know? This was the market delivering a clear, harsh verdict. And boy, did it set the stage for one very tense earnings call. So what on earth caused a drop like that? Well, it was the dreaded double miss, something you really don't expect to see from a company like Synopsys. You can see here, revenue came in at $1.74 billion, just a bit short of what Wall Street was hoping for. But the real shocker was on the bottom line. Earnings per share, they missed by nearly 10%. A miss on both top and bottom lines just screams that something fundamental went wrong this quarter. Okay, so let's get right to the heart of it. We have to dig into the why. What was the core problem that dragged these numbers down? Well, the answer lies in one very specific and very important part of the business. So what exactly was the source of this unexpected weakness? On the earnings call, management couldn't really dodge the question. They had to get specific. Okay, now this chart tells the whole story. It is truly a tale of two completely different businesses this quarter. It's kind of wild. On one side, you have their core design automation segment, their bread and butter, and it was on fire, growing a massive 23% year over year, absolutely crushing it. But then you look at the other side, the design IP segment. It just cratered, down 8%. And that weakness right there was the anchor that pulled the entire earnings report down. So the CEO, Kassim Ghazi, he gets on the call and basically points to a perfect storm of issues. He laid out three big things. First, you've got external stuff, right? New export restrictions for China messing things up, plus significant challenges at one of their major customers. But to his credit, he also owned up to some internal fumbles, admitting that some of their own roadmap decisions just flat out didn't work. So really, it was a mix of things they couldn't control and some things they probably could have. Now, here's where the story gets really interesting. All of this weakness is happening at the exact same time that Synopsys is closing the biggest, most audacious bet in its entire history. So you'd think with an earnings miss and a stock collapse like that, the tone on the call would be pretty downbeat, right? Nope. Management was determined to control the narrative. The CEO actually opened the call by framing Q3 not as a failure, but as a, get this, transformational milestone quarter. He was pointing directly at their massive Ansys deal, basically saying, hey, forget the short-term pain, look at this huge long-term win. And let's be clear, this is a huge bet. We're talking at 35 times billion dollars. The deal closed on July 17th, and the whole idea is to transform Synopsys from being a leader in just chip design, the silicon, to a dominant force in the entire world of engineering simulation, the systems. This quarter, we saw the first little bit of revenue from Ansys, but that's not the point. The real focus here is the long-term integration and synergy story. That's the whole ballgame. And this right here perfectly illustrates the fundamental disconnect this quarter. It's a tale of two completely different narratives. On one hand, you had management selling this grand, multi-year strategic vision centered on Ansys. But on the other hand, you had the market, which, as that 18% drop showed, could not have cared less about that vision in the moment. All investors saw were the immediate, tangible problems: the design IP weakness, the China headwinds, and the execution stumbles. So with a clear problem and a spooked market, how is management planning to right the ship? Let's take a look at their guidance and the fixes they've proposed. Okay, looking ahead to Q4, their guidance definitely reflects this new reality. They're forecasting revenue somewhere between $2.23 and $2.26 billion. Now, this feels like a pretty conservative guide. They're trying to de-risk the forecast, right? Lower the bar. They're baking in the ongoing IP headwinds while also starting to include that more significant revenue contribution from the newly acquired Ansys. To address the problems head-on, management announced a three-pronged plan. First two steps are strategic. They're going to pivot resources in that troubled IP division and conduct a full portfolio review. But the third step, well, it's tactical and has a real human cost. They plan to reduce their global headcount by roughly 10% by 2026, all aimed at streamlining what is now a much, much larger company.
So, with all that as context, what should we expect next? Here it is, our verdict, the official Talk Tickers analysis.
So for Q4 results, we think that de-risked revenue guide is probably achievable, but we see potential for some softness on the EPS number because of margin pressure and all those integration costs. For the stock price, that probably means things stay choppy and range-bound. The market is going to be in full show-me mode, waiting for real proof that the IP business is turning around. So that leads us to a market perform rating. Look, the core business is still a fortress, but the IP uncertainty and the massive task of integrating Ansys, well, it just caps the near-term upside for now. Now, this whole situation gives rise to a really interesting, kind of outrageous but plausible trade idea. You've got this battle between short-term pain and potential long-term gain. So you could consider a paired trade, using short-dated put spreads to hedge against any more downside volatility, while also buying long-dated call options to try and capture that multi-year upside if, and it's a big if, the Ansys integration proves to be the home run management is selling. So at the end of the day, the ultimate question is this. Can a massive long-term acquisition story successfully mask a crack that's just appeared in the company's foundation? I guess we're all going to find out over the next few quarters. And of course, this is not financial advice.